The upside price potential in shares of Nvidia, plus monthly dividend cash flow. This could be the perfect strategy. Hey Bowtie Nation, what was impossible for investors just last month is now a strategy you can use to get not only the upside price return on Nvidia, up 720% over the last 2 years, but also a 19% dividend yield paid monthly. I'm going to show you how to turn Nvidia into a monthly dividend stock, and while there are some ETFs that already do this, why the do-it-yourself approach is so much better. The strategy uses covered calls, an option strategy that not only turns any stock into a dividend-paying machine, but also lowers your risk. I'll explain the covered call, pros and cons, and then exactly how to use it with shares of NVDA. And again, this is a strategy being used by a lot of popular income ETFs like the QYLD and the NVDY, promising dividend yields of 50% and higher. But it's better to do it yourself, and so easy. The covered call strategy is one of my favorites and a great way to lower your risk on a stock while also turning any stock into a dividend-paying machine. In the strategy, you sell a call option for every 100 shares of stock you own. Now, this means you sell to another investor the right to buy your shares from you at a set price, called the strike price, and for that option, they pay you a cash premium right now. You can think of that cash you collect in two ways. One, it lowers your risk in the stock. That other investor is taking some of the risks that the price increases because if it doesn't, the option is going to expire worthless and you're going to keep the shares. Another way to think of this though, and I'm going to show you how to set this up in this way, is you're creating a dividend whenever you want. You're turning Nvidia into a high-yield cash machine. The pros of the covered call strategy are that cash flow and the risk reduction. You're getting a cash payment, and if the stock price doesn't reach that option strike price, you keep the cash and the shares, and then can sell more calls against it for even more cash. But then you know what we say here on the channel. It ain't all rainbows and unicorns. The downside is you do limit your upside in the stock if it surges higher. Now that's not something you want to do with a stock that has doubled in price over the last year, so I'm going to show you how to reduce that risk. Knowing that each option contract is worth 100 shares of stock, and you start to understand why Nvidia investors could not use the covered call strategy before its 10-to-1 stock split this month. To sell just one call option, you'd need to own 100 shares. And I'm going to show you in the walkthrough why this strategy is really best used with at least the 300 shares of the stock. But even 100 shares at that pre-split price of $1,200 each, you would have needed an investment of more than $120,000 in Nvidia. Now though, post-split with shares around $121 each, you need just $12,000 for the 100 shares to sell a call option against it. I'll walk you through this option strategy to turn Nvidia into a monthly dividend stock next, but check out the launch of my Ultimate Options course for all 29 option strategies. The option strategy in this video is one of my favorites, but in this course, I'm going to take you step by step into 29 strategies, including one that will make your money back fast on a losing stock. Over 3 hours of video, I start with the basics, then walk you through each option strategy, when to use it, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy, and an options calculator to show you exactly what to expect. Now, right now, I'm launching the course at a 38% discount. Save $150 off, but only for the next 3 days. You're going to get all the basics to get you started, the strategy finder to make sure you're using the best strategy, and the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. That $150 launch discount is only available with the coupon code in the link I'm going to leave in the description below, so look for that or scan the QR code here. Now I want to show you how to set up Nvidia as a monthly dividend stock. Now I'm not going to get into the bull or bear case for if you should buy shares of Nvidia right now. I did that recently in a video including a range of price forecasts for NVDA, so I'll link to that video in the description. Check that out next for Nvidia analysis and price predictions. Here I'll walk you through the strategy, including an extremely important step that's going to keep taxes from eating your soul. You're going to start collecting that monthly cash flow immediately, but for the strategy, for the first 11 months, it's going to be slightly different to get that better tax rate. To start, you need to buy at least 100 shares of Nvidia, but the strategy works best if you can buy 300 shares. It's going to be a bigger chunk to invest, but will mean better upside return and cash flow. Each month, you'll go to the Nvidia options on whichever investing site you use. You can see here there are options available for Nvidia on a weekly basis, monthly, and even out more than 2 years. Now we're creating monthly cash flow, so we're going to use the July options, about a month out as I put this together, but you can use any of these. Using monthly options means you can repeat this every month for that cash flow, while using those longer dated options like those expiring next January means you're going to collect larger cash payments. Here there are two numbers you need to understand in this table. First is the strike price here in blue. Now that's the price at which you're agreeing to sell those shares of Nvidia to another investor if they buy that call option. The other number here is the last price, which is roughly how much you're going to collect in cash per share if you sell them that option. You can see here, as that strike price gets higher, the option premium, or that last price, gets lower. With shares of Nvidia at $122 each right now, if you're giving an investor the right to buy those shares at a lower price, say $15, they're going to be willing to pay you a lot more than if you agree to sell the shares for $20 or $100 a share. So then picking that strike price, the price at which you'd be comfortable selling your shares, means understanding how much you think Nvidia might go up over the next month. Of course, past performance of a stock does not mean that it's going to behave the same in the future, but I graphed out monthly price changes in Nvidia over the past 5 years. You can see it's jumped as high as 36% and fallen as much as 32% in a single month, but the average has been right around an 8% change, and most of these are in a tight range between 0 and 12% higher every month. Now, you might change those expectations if there's a news or an earnings release expected over the next month, but if Nvidia were to go up 8% over the next month, the share price would approach $132 a share. Now, it's around that price that we're going to start looking at selling those call options because, remember, that strike price is the price you're agreeing to sell your shares of Nvidia if it gets to that point. For the strategy, we want to set the strike above where we think the stock is going to be over the next month. So we're going to keep those shares, but we also want to collect as high a cash payment as possible. So we can look at the different strike prices here and the cash premiums. At a $130 strike, we would collect a $4.20 premium. So the investor would pay you $4.20 per share for that right to buy your shares of Nvidia for $130 each over the next month. If the stock made it to $130 or higher, they buy it from you for that amount. If not, then you keep the shares and the money. The other investor isn't going to buy your shares for $130 if they can just buy them for less in the stock market. Now, if we did collect that $4.20 per share with the stock right now at $122 each, that would be like getting a 3.4% dividend over the next month, or a 41% annualized dividend. Now, that's how the ETF that I'm going to show you later is promising that super high cash flow, but there is a big risk here. That $130 strike price is only about 6% higher than the current strike price, so there's a good chance that you lose the shares for that price. Since the idea here is to collect that high dividend yield, but also keep as much of the upside return potential in Nvidia as possible, we're going to look at some of these other strike options instead. Here for the $135 strike, we're collecting at $2.85 a share, or about a 28% annualized dividend, but we get that extra upside return to $135, or about 10% higher. That is still more dividend than I need, and there's a reason I'm going to explain later why we want to be extra careful these first 11 months that we don't sell our shares of Nvidia. So I'm going to use the $140 strike price here, which means NVDA have to jump nearly 15% in the next month alone to get the shares called away with that option. Here with that $1.95 per share premium, we're still collecting about 1.6% a month, or a 19% annualized dividend, which is great cash flow. So again, if you bought 100 shares of Nvidia for just over $12,000 each right now and collected $1.95 each for selling the $140 call options, you'd collect that $195, which is a 1.6% cash return for the next month, or about 19% annualized. Fine-tuning the strategy, and why I say it's best to buy 300 shares and only sell the call option on 100 shares is because this still allows you to collect that cash dividend, but leaves the other 200 shares with unlimited upside potential. Remember, shares of Nvidia have jumped as high as 36% in a single month, while setting the strike price higher to $140 on the option still leaves us 15% upside to that price. It does limit our return if Nvidia jumps. I love collecting the cash flow, but it would suck to miss out on that monster rally, so having some shares uncovered gives you the best of both worlds. And here, why I say we want to be extra careful in this first 11 months owning the stock is because Uncle Sam just loves these monthly income strategies. That's because taxes on options are different depending on how long you hold the stock. We're short the call option here, so in the third column, you see that if that call option expires, then you report that cash collected as income and pay the income tax rates. Comparing tax rates, you see why that's so important. Ordinary income tax rates are as high as 37%, or nearly double the highest rate on investment capital gains. In fact, if you make less than $40,000 single, you pay no taxes on your capital gains. So paying income tax rates on that cash collected for the strategy isn't great, but there is a way we can lower those to get those capital gains rates. Look at the middle column here. If the call option does get exercised, if that happens and we've held the stock for more than a year, then the option premium and whatever we make off that stock is considered long-term capital gains and taxed at that lower rate. That's why when you're using this strategy on a stock you haven't yet held for at least a year, you want to set that strike price high enough that you're confident the stock isn't going to reach that point. You want to keep that stock for at least the 12 months because after that, if it does rally and the call option gets exercised to buy the stock from you for that price, then you're going to save thousands of dollars on taxes. Folks, I know there's a lot of numbers to throw at you and a lot to think about in this strategy. Do not feel like you have to understand this perfectly right away. Think through it, maybe watch through it again, because whatever time you spend on this is going to be worth it. Collecting that double-digit dividend yield on a stock can produce a 30 and 40% annual returns. This is actually similar to the strategy used by the YieldMax NVDA Income ETF, ticker NVDY. But before you see that 47% dividend yield and get excited, I'm going to show you why that do-it-yourself approach is a much better option. The YieldMax ETF uses a combination of call options and put options to simulate owning the shares, a strategy called a synthetic stock position. It's a way to get the same up and downside exposure to a stock at a fraction of the cost, and one of those 29 strategies you'll see in that options course. Then, to generate that monthly income, you can see here at the bottom that the fund sells those call options, these negative positions worth about $9 million. It's this money, along with the interest on government bonds, that the fund uses to pay those monthly dividends. What is not to like? The Yahoo page for the fund shows a 48% dividend yield, while the homepage for the ETF shows a spectacular 98% distribution rate, but with a big giant asterisk to the fine print. And that fine print is that the yield depends on how you measure it, why you see different yields, and why you're probably not going to get that dividend that you expect. For Yahoo Finance, they're assuming that previous 12 months dividends are repeated, so about $14.65 divided by the current stock price of $30 per share is that 48% dividend yield. For YieldMax, they're assuming that the most recent dividend of $2.56 is paid every month over the next year for that 98% dividend. But one look at the dividend history and you see how ridiculous that is. While the dividend payment has generally increased along with the stock price, it's bounced around so much that you can't assume anything. But no matter how you measure it, that dividend yield does look tempting until you see how the NVDY has done against just owning shares of Nvidia outright. Including the dividend, investors have made 125% total return over the last year in that NVDY ETF, which is outstanding compared to just about any other investment, but not when you compare it to that 209% return you would have gotten just buying shares of Nvidia. That do-it-yourself approach, setting the call strike price a little higher so you don't lose those shares after every bounce higher, would have benefited from that run in Nvidia, and you would have made a lot more money. But then there's also two bigger reasons why you want to do your own covered call strategy, that DIY strategy, rather than just buying the NVDY income ETF. First, if we go back to that dividend history for the fund, there is no way you can plan your income around that. From month to month, you could be getting $2.50 a share, or you could be getting 41 cents a share. You never really know. Owning shares of Nvidia yourself and then selling those call options, you can plan exactly how much income you're going to receive because you set the strike price. You have total control over which options you sell and how much you receive. Another problem though with the NVDY is that the dividends are non-qualified for taxes, meaning you will always pay taxes at those higher income tax rates for the money you receive. Now, selling a call option, generally that money is going to be added to your income and you're going to pay those higher rates on the DIY approach as well, except in that one very important case. If the call option is exercised and gets bought away from you, those shares get bought away at that strike price, if you held the shares for more than a year, you're going to pay those lower capital gains rates taxes as low as 15% or even 0% for the money you collected on the option. It does take some planning, but it can lower your tax bill by thousands of dollars, and it's the way to go on these monthly income strategies. Get that special launch discount and save $150 on the Ultimate Options course from beginner to 29 option strategies. Don't wait though, because that launch discount is only open for the next 3 days. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.